Welcome to the HMO Success podcast and videocast. Because I'm doing both these days, recording it for my YouTube channel. Welcome if you're new to the YouTube channel, and also welcome to you if you haven't listened to the podcast before. There's loads and loads of back episodes, loads and loads of things to do with HMOs, whether it's to do with licensing, regulation, or ideas, or how to build and scale your portfolio. I'm your host, Wendy Whittaker-Large, and I've been investing in HMOs for a long time now, over 10 years. And in fact, I even dabbled in HMOs many, many moons ago before I really got going 10 years ago. I'm delighted today to have a very special guest on this videocast because this is a buddy of mine who I've known for, well, it must be a decade, I would imagine. And he still is busy beavering away in Manchester. So George Samoila, it's great to have you here today. And I'm sorry if I've mispronounced your surname.
Wendy, that was perfect. Thank you for that. Thank you for that glowing introduction and for being able to say my name on the first go. So appreciate that.
Very good. Now, George, you are a man of many talents, and I know that because I have sat in a breakfast meeting with you, which you host, and we'll talk a little bit about that. But I've sat in that breakfast meeting with you either virtually or in person many times, and I know you are incredibly well experienced when it comes to property. Not only do you run a sourcing business that helps other people to invest in property and achieve financial freedom, you're extremely experienced when it comes to refurbishment and building. You know your market incredibly well, and you don't just do HMOs, you do lots of other projects as well. You also host what I consider to be, this is a bit of a drum roll or a trumpet sound. I would say one of the best one of the best networking breakfast meetings in the UK. I have attended many, but yours is one of the best in Manchester, and we'll put the details on. So if anyone's interested and you want to attend a fantastic breakfast meeting, the Manchester breakfast meeting is the one to go to. George hosts it incredibly well. He allows people to have their time to air their challenges, problems, issues, questions. It's a brilliant way in which he hosts that particular meeting, and you'll come away with lots and lots of learnings and lots of insight as well. So if you are in the Manchester area or investing in the Manchester area, I completely recommend George's monthly property breakfast meeting. You should get along there. But George, before we perhaps talk about that and how that came about, I'd love to hear a bit more about your background. How did you find yourself doing what you're doing today?
Oh God, that's going to be a long-winded answer. So me and my wife, Mirella, we came to the UK to study in 2011. We started an e-commerce business, which my wife still runs. And we made some money from that and just started investing in property. We're originally from Romania, and in Eastern Europe, house ownership is quite important. So we always knew we wanted to invest in property, and we really took advantage of what the UK has to offer in terms of buy-to-let mortgages, tenants' rights, landlords' rights. So we really liked the whole setup compared to back home where things aren't that well regulated. So we bought some property and then did a bit of property training and understood that you can do HMOs, you can do service accommodation, you can source. So things really ramped up after that. So that was in 2018. And then in 2019, I went full time into property, doing building work for investors. So through our construction company, mainly converting properties to HMOs, then sourcing mainly for overseas investors, offering them a turnkey service, and also growing our portfolio quite aggressively. So it's been a busy number of years.
Yeah, absolutely. And before we launched on the videocast today, we were talking about freedom, time, Oh yes, all that kind of, not being really busy. And we would, just saying it's not like that. It's not like that at all. It has peaks and troughs, and the peaks are very, very busy, lots going on, lots of juggling, and then other times when actually, yeah, it probably is a little bit quieter. So, that's good. That's good. Well, you've done incredibly well, I think, George. And, now in Manchester, you've got a fantastic network. Just the WhatsApp group for the Manchester Property Breakfast must have hundreds of people on it. And that in itself is a fantastic resource for anybody who comes to the breakfast meeting, because you automatically add them to that group. And even if you only have attended once, you're very generous. You join them to that WhatsApp group, and then they can ask any questions. And there's such a wealth of knowledge in that group, isn't there?
Yeah, I think it's a bit of a hack, if I'm honest, because if you're not based in Manchester and you're just looking to grow your network, get a foothold in the market, you just come to one of the meetings. Hopefully, you're coming to a couple more meetings after that. But if you can just come for one, you get added to the WhatsApp group, and then you have everything you need there, from mortgage brokers, builders, insurance brokers, other investors. So if you're just starting out and you're thinking, oh, I wonder if I can do this strategy in this particular location, it's an amazing resource because you can sense check stuff, you can ask for help, and everyone's really friendly. And I've been on the receiving end of that as well. And I want to think that I've given back to the community also. People are quite nice. If you want to go and see a project someone's working on or have a call and ask specific questions, it's all in the WhatsApp group.
Now, tell me a little bit about why Manchester. Did you just end up in Manchester? Was it a deliberate decision, or did you have some reason why you focused on Manchester?
Good question. I think it was also because the university I was in had a partnership with MMU. But from a personal point of view, and also from an investment point of view, I've always liked secondary cities. I think, London is amazing, but it is very, very crowded, very busy. The prices are quite high. And from a personal point of view, you tend to get priced out of these bigger cities. So once you get to the point where you want to start a family or you want a bigger house, you tend to get just pushed to the outskirts, which isn't great, is it?
And so you found Manchester to be more affordable and presumably therefore scalable for your business.
Yeah, so I think we managed to get a very, very good run in Manchester. I speak to investors every day about it, and I still remember it wasn't that long ago. So, for example, in some postcodes, properties were on the market, say 7 years ago for about 50 grand. And now they're 150, 170. So we've seen a huge, huge increase. And in my mind, obviously we all like HMOs, we like the cash flow. But in my mind, the biggest thing in property is capital appreciation. And we've seen that firsthand through our buy-to-lets. And yeah, it's been a good ride, and it's still quite active.
Well, I wanted to ask you about that. So, yes, you've done a lot of HMOs. You've done some for yourself. You've done many for other investors. Tell me a little bit about. Well, it'd be great to hear about a project or maybe a deal that you've done. Is there one that you can put your finger on and go, do you know what? I'm really proud of that one. That really got my blood racing. This is just a brilliant project. What is there one that stands out to you?
Yeah, so we've done a couple. I think I've been very specific in the way I help investors find properties, and in my own portfolio. Um, I don't like the big HMOs for two big reasons. One, the biggest one is planning, because planning can take, especially in Manchester, so it might be different in other places. It can take 9 to 12 months, and it's quite risky. You're sat on a property for 9 to 12 months. what's the point? So I'm a big advocate of 6-bed HMOs. So in non-Article 4 areas, you don't need planning for that. And we've done quite a lot of them. I think, we've enjoyed all of them. And even my wife in the e-commerce business, she's loved the journey as well, because we used to offer landlords a staging service as well, and that's the thing she loved most. Spending a day out at BM Bargains, just kitting out the properties. There's so many nice memories with all of them, and I don't think I have a favorite, if I'm honest. It's just taking properties. For me, it's about the where we start and then when we finish. We've had so many nice properties where they were either cannabis farms, or if we went to planning on one of ours, I've even made the newspaper. The neighbors were really upset. They all formed WhatsApp groups, and they said, "Oh, it's going to be a terrible property." And then we converted it into a really nice 5-bed, and they're all happy with it now. But I don't hear anyone posting any congratulations on Facebook, unfortunately.
No, absolutely. You'll hear the criticism when you do something wrong, but you don't necessarily get the praise when you do something well.
Yeah, exactly.
That's
exactly.
very true. That's very true. Well, that's great that you've kind of got a niche. You found your niche in terms of what you do with HMOs, and presumably you must find that the finances also follow. Can you tell us about that? What maybe challenges you've had with finances, or even what big wins you've had?
Oh, good question. Good question, Wendy. So I've been quite vocal about this, not getting the valuations I wanted for HMOs. And I think this is something most investors can relate to. We're all chasing that particular valuation that we're not necessarily, get all our money out from the project, but somewhere where we feel comfortable with the investment. And this is something I've struggled with the most, and I've been quite open and honest about this with everyone I speak with, fellow investors or people I help invest. But in recent years, it's been a double-edged sword. So we were getting not great valuations on the front end, and that was quite upsetting. But equally, that forced us to be very good with the numbers, so buy at the right price, refurb at the right cost, and then manage the exit. But now we've just had to refinance our first HMO a couple of months ago, so we're 5 years in. And trust me, it's been a massive blessing, with how much interest rates have gone up, not having the stress of having a huge mortgage and see our mortgage payments, double or increase, twofold has been really good.
Yeah, and I think that's a really salutary lesson, and I think, George, it's a very important point that there's this sort of holy grail of recycling all your cash, getting all your money out. And I know a number of HMO investors who they feel that that's the only way they can grow their portfolio is by, buying cheap, doing a reasonable refurb, and then having it valued up sort of, at a much, really inflated price. And I know that some people in the south can do this quite easily, but in the north and the northwest, it's not so easy for us to do that. We certainly have to add much more value, maybe by planning gain or other mechanisms, to be able to pull all that money out. It is possible, but you're right, it's not predictable. And I think a lot of people fall down because they are basing a lot of their numbers on that determined outcome, which is that they will recycle all their cash. And then when the valuation comes in, and maybe when the second valuation comes in, and it doesn't kind of hit that target on their spreadsheet, they're distraught. What am I going to do? What am I going to do? And I think it's very, very good to hear you have that rather more cautious approach, which says, well, hold on a minute. what value would you need to still make this project worthwhile? Because ultimately you are still you're going to be getting a better cash flow if you don't leverage everything out of it. And as you say, when it comes to future financing, you go, oh, I'm so glad that we shouldered that pain for the last few years, because A, our cash flow has been better. B, now that that property has also continued to go up in value, as you say, capital growth, our loan to value is probably maybe 40 or 50%. And suddenly you begin to think, do you know what? I like this property business. I don't mind doing HMOs.
Yeah, that's exactly it. I think, as investors, we all tend to be a bit greedy. So we all want the cash flow, we want the capital appreciation and the cherry on top. But in my experience, there's always a balance. So if you have very high yields, you're most likely going to have lower capital appreciation. If you're geared very highly, then yeah, happy days. You've pulled all your money out, but then you have lower cash flow. So I think there always needs to be a balance, and all over our portfolio we can see that we've got pockets that are a bit more risky, strategies like SA or a bit of HMOs, and then we've got the buy-to-lets which are just ticking along and doing their thing, and they're not giving us a lot of headache.
Yeah. And actually having that mixed portfolio is also a really good hedge to changes in the marketplace, because you've got different forms of accommodation that you can offer. Now, George, you're very much centred on Manchester. You know Manchester incredibly well, north, south, east and west. But I'd like to get your take on what's happening right now as you see it in that marketplace in HMOs. What are some of the trends and some of the changes that you're seeing?
Good question. We're seeing massive increase in demand. And we've been seeing this since COVID. And finally, since COVID, we've seen an increase in room rates. We've been waiting for rents to go up on HMOs for, I'd say, a good number of years, probably. So we're now 2024, about 4 or 5 years. Before 2019, 2020, we hadn't seen a major increase in room rates.
Now that's quite interesting, because where we are, we saw a big spike in room rates probably about 18 months ago, maybe 2 years ago. Like you, it plateaued for a number of years, and then all of a sudden we saw rates really start to go up. So there's obviously a sort of wave, isn't there, where it seems to happen in different parts of the country at different times, but it's more or less kind of filtered across most regions, I think, now.
Yeah, it's hard to say really why it's happening. It's definitely a mix of interest rates going up, it's bills going up for landlords, and hopefully a mix of supply and demand. There's a big shortage in housing, as we know. A lot of people are looking for alternative ways to manage their outgoings with a cost of living crisis as well. So I think HMOs definitely tick a lot of those boxes. And that's why we're seeing a lot of increase in demand. And also, with a growing population, Manchester has been seeing. It's no surprise, but it's been a long time coming. And I think we're quite lucky to get it now. And for anyone that's been looking at HMOs for a number of years, or is looking to get into the market, it certainly helps your end value, your GDV, and it helps you if you've made a couple of mistakes along the way, which we've all been guilty of.
Yeah, definitely. And I think one of the things that, of course, is, again, people who are experienced would know this, that there's a lag effect, that you quite often will develop a building, and if you are predicting your cash flow on the basis of today's rental values, that's a safe and secure way to do it. But it's worth remembering that it's very likely that those rental values will increase over time. What we can't predict is when it's going to happen. So you might think, it's going to be like next year, suddenly we're going to see 10% rents go up again. But in fact, it could be 16 months, 18 months, 20 months from hence. So there will be an increase, but it won't happen immediately. And the other thing that I often say to people is, remember, when you're buying a property, the time it takes these days to undertake the conveyancing, by the time you've actually got the keys on that property, it's probably worth another 1, maybe even 2% more than you sealed the deal with the vendor or with the estate agent, because it might be 6 months. I've seen, people buy HMOs over the last year or two. It's taken them 6 months to get the keys. So you think, well, if there's 4% inflation in that price, you've maybe got 1 or 2% just in, the time it's taken for you to buy the property. So this kind of lag effect, the time effect of money, is something which I don't think we always, conceptualize, but it's a very important part of that wealth that you can, it's slow but sure building that wealth, isn't it?
Exactly. I think this is the biggest thing we've come to realize as well. We've been buying since 2013, and it's just, you're so stuck into doing the do, and you're not looking at how much prices have gone up or how much rents have increased since you ran the numbers at the beginning. And we've been doing a lot of that lately, just looking at how much our portfolio is geared at. And yeah, it's been a very, very nice surprise. So
Yeah,
time in the market is much better than timing the market.
Yes, absolutely. Particularly with property, I think property is very, very, that's very, very true. So, what are you? Can I ask what projects are you working on at the moment, George?
A lot, really. It depends what we're looking at. For my own portfolio, I've been doing a lot of moving around, just making sure we've got a very good foundation. We've grown quite aggressively. And on the HMO side, we're coming to about 3-4 years into the HMO, so we need to do a bit more maintenance. So that's been a lot on my mind lately, just making sure the rooms are up to spec. So for me, I'm not buying anything at the moment, just because we've been very busy paying all our investors back. We've been very fortunate to work with a lot of private investors, but I think there's a time to grow and also a time to make sure you're not growing too aggressively and you're not leaving yourself open to bigger changes in the market. I think the worst is probably behind us, but it's been painful, and I think a lot of investors can relate to this. Having the rate increase we've seen over the past 2 years has been, I want to say, unexpected, and it has been unexpected because I didn't expect it to go up to 5.25. So for ourselves, not buying that much, I've been focused a lot on a planning gain scheme where we managed to get planning for a big HMO. I think it was a 10-bed plus commercial space downstairs. We flipped that on to an investor, so we got planning and then sold it to an investor, and we're quite careful with it, not to take all the profit out and leave some for the person that was buying it from us. And it was quite stressful, I'd say. We've gone through 2 buyers, and then the third one managed to complete in 10 days. So that was, interesting to say the least. And for my investors, a bit of everything. We're buying HMOs. I think HMOs mainly for social housing, but not in the Greater Manchester area, because the numbers are quite hard to get to in Manchester, unless you're doing a lot of direct vendor marketing and you're buying at a really good price. I think it's not easy to. We've been priced out of the market, so owner occupiers are bidding us on most of the properties we look at. So we've been focusing a lot on, St. Helens, Wigan, Warrington. The numbers are much better there. There's less competition. And with a social housing contract on top, you tend to get some of the risk out of dealing with HMOs. You don't need to, if someone doesn't pay, then you're pretty much stuck.
Yes, yes. So that's very interesting that you're obviously seeing a growth in the demand from investors for HMOs, but also in the demand from social housing organizations wanting HMOs.
Yeah, I think the local councils have definitely stepped their game up in terms of dealing with homelessness, dealing with supporting families, and there's huge demand from providers that have scaled their operations. I mean, don't get me wrong, I still like professional HMOs, I still like student HMOs, and I'd buy a lot of them. But the problem is you always have to get the numbers to stack. So if you're looking at Manchester, you probably need to look at Ashton-under-Lyne or Oldham to make the numbers work for a professional HMO. There's some postcodes in Stockport that still work because it doesn't have Article 4. So it can work, but there's less properties coming on the market, and there's more demand. And also, from my point of view, I'm quite specific about this. You can add value to an HMO in 3 different ways. You can extend at the back, you can do a basement conversion, or you can do a loft extension. I always want to be doing just one of those, because otherwise you're not going to see the return. You've spent too much money on it to get the valuation you want. So I don't want to do, these huge refurbs where we're knocking the whole house through and creating, massive extensions, or, going both into the loft and into the basement. And there's few properties that lend themselves to this sort of work, because one thing to bear in mind is I want my HMOs to work in the next 10, 15 years. So unless they're all en suite, unless we have a nice big kitchen, with a kitchen diner, a bit of a communal space, then I'm not going to do it. And I'm not saying, everyone else is wrong and I'm right. I'm just saying, for me, there's so much stuff that can go wrong with HMOs in terms of location, the room sizes, regulation. I'd much rather just focus on one specific thing, and that is the top end of the market, delivering really nice rooms. They're big. They all have their own bathrooms, and we can charge the top end rate for our rent, which is what I want to be getting.
Yeah. So you're really talking a little bit there about the law of diminishing returns, that because property prices have gone up, there's fewer properties coming onto the market, and therefore the ones that are coming on are probably being looked at from a both investment and residential buyer's point of view. That of course continues to push prices up as well, and you're ending up with a situation where some areas of Manchester become really unaffordable. Or if you're prepared to get 3 or 4% return and you think that's a good return, great, fill your boots. But I think that those of us who've been doing HMOs for a little bit longer would say, no, we're not interested in those kind of returns, because there's extra work that goes into an HMO. And again, in my experience, it's a little bit peaks and troughs. You can get sometimes when you're doing a lot of work in one particular HMO, you've maybe got one troublesome tenant, you've got a particular shower that keeps leaking, or you've got a particular issue that keeps recurring. And you feel like you're spending a lot of time and effort dealing with that particular HMO. And then suddenly it goes absolutely dead quiet, and it's full, they all get on, they look after the property, there are no maintenance call outs, and you suddenly think, oh yes, I'd almost forgotten about that property.
Yeah, 100%. I agree with that. But, we've seen this in Manchester where property prices have gone up a lot. And then rental prices have gone up a lot as well, both on buy-to-lets and HMOs. And this is where, coming back to what I was doing sort of 4 or 5 years ago, advising investors not to go into these big HMOs, but also on the flip side, not doing the 3-4 bed HMOs. This is where they're probably seeing the benefits of that advice, because if you have a 4-bed HMOs and you look at how much bills have increased, management, tenant turnover, you're probably netting, if you're lucky, somewhere close to what a buy-to-let would net in that area. And bear in mind, you've spent what, 40, 50 grand on a refurb to convert it to a 4-bed HMO. So this is where you have to think about how the market is going to look in 5 years' time, 10 years' time, and prepare yourself for that, and make sure you're making the right decision. Because in my mind, property is a long-term play. Even if it's a cash flow strategy, I'm not in it for 1, 2, 3 years. I have to be in it for 10 years to see the benefits.
And I think it's a very wise thing to say about comparing it with other forms of residential property income, or even property income, because service accommodation isn't really counted as residential. But it's very important, as you say, not to get carried away by this idea that HMOs are going to be this pot of gold at the end of a rainbow. Because you're absolutely right. We've had a couple of smaller HMOs, and around the COVID time, partly because of COVID, partly because of other reasons, those properties no longer were working for us. And they demanded more maintenance, they demanded more input. We'd had them for a number of years and knew that they needed a little bit of upgrade. And yet we saw the demand for single buy-to-lets and how much that had risen, and thought, actually, we could convert these properties back into single buy-to-lets for not much money and get probably as much profit as we were making as a small HMO, and yet there's less time commitment. So it's very important, I think, to look at those, as you say, the market, and the demand for single buy-to-lets is so strong that it would be foolish for somebody to plow ahead with HMOs without considering whether, in fact, a single buy-to-let strategy might be actually better for them.
Yeah,
so,
100%, 100%.
So, George, tell us a little bit about, the next kind of few months for you. What's in store? Is there anything exciting on the horizon? Is it all, plowing away every day?
I think for me, we obviously, when we started, before you started recording, we were talking about more time off, doing a bit, working a bit less. And I think for me, that's been the biggest focus this year. So we've been putting systems in place for a couple of years now, where we can work remotely, and I've been doing a lot more of that. So for me, it's just spending a bit more time with the family, because we all get into business for various reasons, but I think it boils down to a couple. We either want to, get rich, empire build, or we want more time, either for us or for the kids or for the family, and more freedom of choice. And I think we tend to forget that along the way. And I'm certainly guilty of that. I'm a bit of a workaholic. And when I get stuck in, I probably realize 5 years later down the line that I'm overdoing it. So I've been thinking a lot more of actually making the business work for me, not working in the business. So yes, I'm still managing our portfolio, and it's not easy. We've got a lot of mortgages that are coming to the end of the fixed term. We've refinanced a couple, but it's just a waiting game. So, I'm always thinking about, okay, what was the long-term plan? It was easy for a couple of years because interest rates were very high, low. Now interest rates, I don't even want to call them high. I think they're normal interest rates.
Yeah.
We've had, very, very low interest rates for a good number of years, and we sort of got used to that. So keeping an eye on the portfolio, keeping an eye on tenants, on maintenance, doing more on the sourcing side, especially in around the social housing space. I think it solves a bit of the unknown, a bit of the headaches with tenants. The renters bill that's coming out, of course, that's on my mind. But equally, there's always a balance. The interest rates will be higher. Not that many lenders will look at it. So that's the thing with property. It's not just all a total loss or a complete gain. So
Yes.
yeah, just for me, just being careful where my attention goes, keeping the portfolio on track, sourcing for investors, dabbling in coaching and mentoring, enjoying my time with the breakfast meeting, and hopefully spending more time with the family.
Wonderful, wonderful. Well, I know you will manage it because I've seen what happens when George Samoila commits to something. He follows through. He makes it happen. So you will, whatever you decide to do, be very successful, George. And yeah, I'm sure that as you focus on those systems and those processes, you will have more and more time to do what you love. And obviously, eat more big breakfasts. That's on the cards as well.
That's always a top priority for me, especially on the first Friday of every month in Manchester.
Absolutely. Great plug. I love it. I love it. Great. Well, George, it's been an absolute honour to have you. Thank you so much for making the time. And it's been a real pleasure to reconnect with you and catch up with where you are and what you're doing. And anybody who is interested in getting in touch with George, we'll put his contact details beneath so you can contact him directly, have a chat with him about who he is, what he does, and how he can help you. And you really couldn't find somebody who's better placed or experienced to be able to help you find financial freedom through property. Thank you very much indeed, George, for being on the show.
And thank you, Wendy. It's been a pleasure to be on. Thank you very much for having me.